All right, folks, so we have a massive week coming up in terms of corporate earnings, particularly in the tech world, or the mega cap tech stocks like your Apples and Amazons and those kinds of things. And if you've been watching our videos for some time, you know that particularly in the fourth quarter of 2019, coming into January, February, we made a pretty big deal that it is, we weren't calling for a collapse in these stocks. Obviously, I think that's a silly thing to do. These are good companies. But there's a lot of structural imbalances in terms of passive investing bubbles and things like that that is pushing a lot of these stocks or keeping them elevated beyond just their fundamentals. And just one way of looking at this is the following. So if you think about this from a market cap perspective, if you look at the S&P right now, like the popular SPY ETF, Apple's about a 5% holding, Microsoft about a little bit more than 5%, Amazon's another 4%. So you add up a few of those stocks and you're very close. Very quickly you get to about 20% of the entire market cap being just a few stocks. It's much more extreme in something like the Nasdaq 100, which of course is the largest 100 Nasdaq holdings. But there, it's something like 50%. So just a few stocks are basically controlling that entire market. So I'm going to walk you guys through a couple of charts here to hopefully give you some perspective. Now, again, Apple is one of the companies that's going to report this week. And quite frankly, to get right to the point, we think there's risk. Okay. And again, this is not because we think it's a bad company. I have a MacBook right there. I believe this is an iWatch. My iPhone's right there. So this is nothing against the company, but it has to do with the structural imbalances in the market and the way that these things are, the indices are basically constructed. And we think a second round of selling in the equity markets, if and when we get it, could probably be what reverts to the downside these stocks quite a bit more. So let's look at a few charts. So the first one here is going to be looking at the Nasdaq 100 versus the New York Stock Exchange Composite. I've been showing these charts to our clients almost on a daily basis, I think, for the past couple of weeks. But this pretty much tells you that the Nasdaq 100, again, which is very much focused on just a handful of mega cap tech stocks, its relative value or ratio chart, I guess, versus the New York Stock Exchange Composite, which is a much broader swath of equities, you can see it's at all-time highs. One chart that I came across this weekend, and I unfortunately don't have it here, is that the amount of holders of the Nasdaq 100 ETF in the popular Robinhood trading app, which is a lot more focused on millennials, so a little bit less experienced investors maybe, and I don't mean this in a derogatory way just because they're younger, right? You tend to have less experience, it's just normal, right? Just give less years of experience. And the amount of people holding the Nasdaq 100 over the past, right through this massive market sell-off has basically continued to skyrocket. So everyone believes in this, that these things basically can't go lower, these mega cap stocks. And I think we've reached a point where that's probably going to be proven wrong rather quickly. So this is just one chart to keep in mind. The next one here is a monthly chart, a long-term monthly chart of the price of Apple. This is not a logarithmic chart. This is a normal, quote-unquote, normal geometric chart. And what you'll notice here is this massive blowout to the upside. We've talked about this. We've covered this now for months and months. And then, of course, we had a sharp mean reversion move. Remember, Apple, too, from its peak into the lows of a few weeks ago, dropped about 35%. So it's not that they didn't drop. It's just in relative terms, they've dropped less, and certainly rebounded more sharply than a lot of other things have over the past few weeks. But what's concerning to me here is when you look at the monthly charts, and the monthly charts usually tell you the truth if you're willing to take that step back. And what we're noticing here is this is purely technical and purely sort of a candlestick way of looking at it. But if you take this in conjunction with the other thing, it does kind of tell you something. So I think we've had very clear buyer exhaustion in January. In February, we had that real seller follow-through selling month. And again, it's the fact that this is happening on a monthly basis, right? These are not daily charts or 5-minute charts or even weekly charts. These are monthly things. So we think there's a lot of overhead resistance, basically buyer exhaustion up there. So you can think about this through the lens of investor psychology. When you have a stock go back up here, anyone that's been holding the the bag virtually, who bought up here after experiencing a sharp 35% drop. They're probably scared, and they're gonna try to maybe take some profits once you get back into this area, which I think is more or less where we've gotten to right now. Another way of looking at this is by looking at the ratio of the equal weight S&P 500 versus just the S&P 500 itself. I'm going to go back to the chart of Apple in a minute, but this is another way of looking at the same situation where you can see just a few stocks are basically holding everything up, right? So and they're all going to, or a lot of them are going to report earnings this week, and Apple being an important part within this week of earnings. One way you can also look at this is by looking at Apple in relative terms versus the Nasdaq 100. So what I'm going to do is I'm going to take Apple and I'm going to divide it by the Nasdaq 100, the QQQ ETF, and I'll make this a daily chart so you can see this a little bit better. And I'm just going to make this a plain white here, like this. Okay, and you can see that since the February highs, Apple has actually been a relative underperformer. Basically, it peaked its relative performance in January, then it made a marginal lower high in March, and it's been underperforming on the recent rally. None of this means that Apple has to completely fall apart here, but I think that the bid, particularly if we see another leg lower in the equity market, is going to come out of these names, and maybe this week is a tipping point after earnings. Maybe we need another week or two for this to digest. Remember, analysts always need some time to digest things and come up with their new views, and then maybe people start reacting to that. So just keep in mind that we are, in my opinion, in very lofty territory when it comes to these names. Again, I'm going to quickly go back to that monthly chart on Apple, which again has already started to mean revert. But if you were to get a more meaningful mean reversion move, you would have to think that Apple, after blowing to the upside, would be able to get all the way down here to the lower end of the range, which is around 180 at the moment. And from current levels, that's about another 35-36% lower. I'm not saying it's going to happen. To me personally, I can't possibly buy Apple here with this situation, not because I don't think it's a good company, but because of all the imbalances that I just mentioned here. So anyway, folks, I hope this is helpful. Give us a thumbs up like if you enjoyed it. Leave a comment down below, and subscribe. See you soon.